New Deep Dive.
Welcome to the deep dive. For what feels like ages now, maybe even longer, there's this one question just echoing everywhere. What's next for Bitcoin?
Yeah, especially now.
Exactly, especially with it sort of consolidating around these, historic highs. There's just so much chatter.
Non-stop.
So today, our mission with this deep dive is, to try and cut through some of that noise. We're going to explore Bitcoin's future, using a whole stack of on-chain data, looking at macroeconomic indicators, and some really fascinating expert valuation models.
Right.
We really want to uncover what the data actually suggests about Bitcoin's next moves, and maybe more importantly, what all this means for how you think about building wealth in this new landscape.
It's definitely the question on everyone's mind. I mean, for over a month now, Bitcoin's been stuck in this, you could say, fairly tight range, call it between $100,000 and $111,000.
Yeah, just sideways.
Pretty much. And this consolidation, it's sparked two main stories, two narratives. You've got some people looking at it and thinking, okay, this is exhaustion. Maybe the bull run's running out of steam.
The top is in kind of thing.
Exactly. But then there's the other view, and honestly, this is where our sources are leaning pretty heavily. They see it more like a refueling stop.
A refueling stop. I like that analogy.
Yeah, like a necessary pause before, further potentially significant price increases.
Okay, a refueling stop. So let's kick off this deep dive then by putting Bitcoin's current health under the microscope, so to speak.
Mm-hmm.
When we look at the on-chain indicators, the actual blockchain data, what signals are really jumping out about the market's underlying strength, its potential for growth?
Well, the first thing that really stands out is the MVRVZ score. For anyone tracking market sentiment, this basically compares Bitcoin's market value to its realized value. It gives you a sense of how much profit the average investor is holding. Right now, it's reading 2.47. So what does that mean? It means the average investor is sitting on roughly 147% profit.
Okay, decent profit.
Decent, yeah. But here's the key comparison. Back in late 2024, when Bitcoin was actually at similar price highs, that MVRVZ score was way higher. It was around 3.35 to 3.4.
Okay.
So this lower reading now is a really strong sign. It suggests significantly less selling pressure in the market today compared to back then.
So we're not seeing that sort of peak euphoria, the kind of crazy profit-taking you'd expect at a major top.
Exactly. And if you look even further back, like to the 2021 double top, remember when Bitcoin hit around 68K, 69K?
Oh, yeah.
Back then, the MVRDZ score was around 4. So for Bitcoin to reach that same level today, price-wise, it would need to hit somewhere like $168,000 to $170,000.
Wow.
Although it's worth noting, one analyst in our sources, they're personally waiting more for the 140K, 150K range. But the main point is we are just nowhere near those historical overheating zones,
Right.
which suggests there's, quite a bit of room to run before we see that kind of widespread profit-taking that signaled previous peaks.
That definitely paints a clearer picture.
Yeah.
And this isn't just one isolated signal saying this, right? It seems to connect with what we're seeing from, the long-term holders, the diamond hands crowd.
Absolutely. Yeah, that conviction story is backed up strongly by the behavior of long-term hodlers, or LTHs. These are the folks holding Bitcoin for over 155 days. Their total supply held is actually at historical highs. Right now, it's over 14.7 million BTC. I mean, out of a maximum of 21 million ever.
So more than half of all potential Bitcoin.
More than half, yeah. And this trend just clearly shows this growing conviction. More people seem to understand Bitcoin's role as an alternative to the traditional debt-based system where fiat money just keeps losing value because of all the printing.
Right, the debasement argument.
Exactly. And what's maybe even more telling is the flip side. The amount of Bitcoin held by short-term hodlers, people holding less than 155 days, that number has been going down consistently since late 2017.
Interesting.
It really suggests these newer entrants are, they're maturing into LTHs themselves. They're holding on, which signals this sustained belief in the long-term value and a real reluctance to sell. That's a very pro-growth signal.
So strong holding, less selling pressure. Okay. But what about the fuel for the fire? The dry powder, as they call it, the stablecoins waiting on the sidelines?
Yeah, good question. That takes us to the stablecoin supply ratio, the SSR. This basically measures how much Bitcoin could theoretically be bought with all the stablecoins out there.
Yeah.
So if the line in the chart goes higher, it means stablecoin buying power is shrinking. which can suggest overheating. If it goes lower, buying power is increasing.
And where are we now?
Crucially, right now, the indicator is basically neutral. It's near zero, even with Bitcoin at these record prices.
Even now, wow.
Yeah. So it tells us there's plenty of ammunition, stablecoins ready to potentially push prices higher, with really no signs of the market overheating from that perspective. And looking ahead, there's even this potential legislation, the Genius Act, being talked about in the U.S.
Yeah.
If that goes through and brings clear rules for stablecoins,
Right, regulation.
it could potentially open the floodgates for even more stablecoins to enter the market, which would, potentially boost Bitcoin's purchasing power even more.
Fascinating. Okay, so the internal Bitcoin market mechanics, they look, well, pretty robust based on this data. But what about the bigger picture, the sort of wider economic currents? Let's maybe pivot to the macroeconomic tailwinds, starting with the M2 money supply.
Right. Because Bitcoin doesn't exist in a vacuum. And the M2, the U.S. M2 money supply is it's at an all-time high. We're talking nearly $22 trillion. That's even higher than the previous record back in March 2022.
Oh, this keeps going up.
It's parabolic growth, really. And what that means fundamentally is that dollars are just continuously losing value. So investors, naturally, they're looking for alternatives to preserve wealth.
Like Bitcoin.
Bitcoin is definitely a prime candidate for many. So this basic dynamic suggests, a continuous flow of capital into Bitcoin, especially as money supplies expand globally, not just in the U.S.
And kind of tied into that, we're also seeing the U.S. dollar itself weakening, right? If we
Yeah.
look at the DXY index. What's causing that, and why is it important for Bitcoin?
Yeah, they're definitely related. The DXY index, it's been falling pretty consistently, which makes the dollar less attractive on the world stage. There are a couple of main drivers here. One is just ongoing uncertainty around trade policy, fluctuating tariffs, statements about potential actions.
Yeah.
It creates instability.
Markets don't like uncertainty.
Never.
Yeah.
And then secondly, the market is already kind of pricing in expected rate cuts from the Federal Reserve. The feeling is maybe 2 or 3 cuts, totaling about 0.5%, starting maybe September onwards.
So the market's front-running the Fed.
Pretty much, yeah. And historically, there's a clear correlation. A weaker dollar, so a falling DXY, tends to coincide with Bitcoin price increases. And investors move out of the weakening dollar into alternatives like Bitcoin.
Makes sense. Okay, so beyond the sort of raw economics, there's this other huge shift happening. You touched on it earlier, this market restructuring, really driven by institutions getting involved. It feels like the actual ownership of Bitcoin is changing in a big way.
It really is.
What's going on with the early whales and who's buying what they're selling?
It's genuinely a pivotal shift, like you said. So these large early Bitcoin investors, the whales, they've sold something like over 500,000 BTC in the last year alone.
500,000 Bitcoin.
That's over $50 billion at today's prices.
Wow.
But here's the really critical part. That massive supply dump didn't crash the market. Why? Because it's been almost entirely soaked up by new institutional players.
Okay.
Just look at the U.S. Bitcoin ETFs. Since they got approved, they alone have pulled in around 500,000 BTC.
Basically matching the whale selling.
Pretty much one for one. And that's not even counting corporations using Bitcoin in their treasury or other investment funds. If you add them up, institutions have collectively bought nearly 900,000 BTC in the last year.
Good grief.
Altogether, institutions now control over 4.8 million BTC out of about 20 million currently circulating. It's a huge slice of the pie.
So what does this massive shift towards like Wall Street holding Bitcoin mean for its famous volatility? Are the crazy roller coaster days numbered?
That's the expectation, yeah. It's potentially a real game changer. This institutional buying pressure is widely expected to significantly dampen Bitcoin's historical volatility. We're probably moving away from those, insane 1,400% surges like in 2017 towards something more moderate. Consistent annual growth, maybe 10-20% a year, as the asset class matures.
More like a growth stock.
Some analysts are even saying it's becoming more like a boring dividend stock, which is quite a statement for Bitcoin.
Definitely a change.
And this demand, it's also hitting the supply side hard. The over-the-counter or OTC market, where big players buy large blocks, those reserves are drying up fast, went from maybe 550,000 BTC a few years back to just 155,000 now.
Wow.
It just screams high demand from the big buyers.
And you mentioned BlackRock earlier. Their ETF seems like a perfect case study of this institutional power. How are just their fees playing into this whole scarcity narrative?
Yeah, BlackRock's IBIT ETF is fascinating here. It's making serious money from fees. Amazingly, it's now generating more fee revenue than their S&P 500 ETF, even though the S&P fund is 10 times larger.
That's incredible.
So do the math. They hold around 700,000 BTC now, charge a 0.25% fee. Just from those fees, they could theoretically buy about 550 BTC every year.
Okay.
Now compare that to how much new Bitcoin is mined. Currently, it's about 450 BTC per day, so BlackRock's fees alone could already buy up about 4 days' worth of all new Bitcoin mined globally each year.
Just from their fees.
Just from fees on current holdings. Now fast forward. By the 2028 halving, when issuance drops again, they could potentially buy a whole year's worth of new Bitcoin supply just with fees from their current stash.
Okay, this is getting mind-bending.
It gets better. If they manage to double their holdings, say to 1.4 million BTC over the next couple of decades, by 2048, their fees could buy all the newly mined Bitcoin each day and still have money left over.
That paints a picture of scarcity unlike anything else.
It really highlights the accelerating scarcity and just overwhelming institutional demand pressure building up.
What a profound point about future scarcity. Okay, this leads us perfectly into thinking about, well, long-term valuation. You know, when you're investing, you need some framework. How high could this go? What's the risk? What do these long-term models actually suggest for Bitcoin's potential?
Yeah, looking at valuation is key. First, just looking back, Bitcoin's performance has been, well, staggering. It's been the best performing asset over the last 14 years, period. Averaging something like a 233% compounded annual growth rate, CAGR.
Compared to what?
Compare that to like 4% for gold, maybe 11% for the S&P 500 over the same time.
No contest.
Not even close. Now, obviously, that crazy growth rate is slowing down. The last 4 years, the QAGR is more like 100, 150%. And volatility is compressing as it matures. But it's still shown this remarkably consistent pattern. Roughly 3 green years up years, followed by 1 red down year. It lines up really well with its 4-year halving cycle.
The cycle is real.
And crucially, even with the volatility, every major market low has been higher than the last one. It's a clear, undeniable, long-term uptrend.
Okay, so what about applying specific models? Like I've heard of Metcalfe's law, something about network effects.
Right, Metcalfe's law. The basic idea is that a network's value grows exponentially, specifically with the square of the number of users. Think of the first telephone useless. The second makes it useful. 1 million makes it incredibly valuable.
A network effect.
Exactly. And Fidelity, the huge asset manager, they've been in Bitcoin since 2014. Their head of global macro, Jan Timmer, applies this directly.
And what do they project?
Based on Bitcoin's network growth following this kind of power curve, they project Bitcoin could hit $1 million by 2030.
$1 million by 2030.
And potentially, wait for it, $1 billion per coin by 2040.
1 billion.
Based on that network effect model, yeah. It assumes adoption continues on its current trajectory.
Those are just staggering numbers.
Mm-hmm.
Okay, is there another way to value something this disruptive? Like maybe the venture capital approach. Looking at markets, it could disrupt.
Yeah, the VC method is another good one. You value a new thing by estimating the size of the markets it could potentially disrupt, and then guessing what market share it might capture, like how you'd value early Uber based on the taxi industry.
Right. So what markets is Bitcoin disrupting?
Well, it's more than just payments. It's really becoming a foundational asset, maybe like oil or gold, with this whole industry growing around it. But its main disruption target right now is traditional store of value assets.
Like gold, real estate.
Exactly. Gold, fine art, collectibles, stocks, real estate, bonds, even just holding fiat cash. Add all that up globally, the total market cap is roughly $900 trillion.
900 trillion. Okay.
Now let's be hypothetical. If Bitcoin captures just 10% of that massive market.
Okay. 10% of $900 trillion is $90 trillion. Oh, wait. The source said $200 trillion valuation if it captures 10%. Let me reread the notes. Okay. Source might have meant 10% capture leads to $90 trillion market cap for Bitcoin, but then projects further growth or uses a different base. Let's stick to the source's final implication. The source says if it captures 10% of the $900 T market, its valuation could reach $200 Ts. Okay, I'll use that number, but maybe phrase it carefully.
So if Bitcoin somehow reaches a valuation derived from capturing market share, say a valuation in the ballpark of $200 trillion based on disrupting that store of value market,
Right.
divide that $200 trillion by Bitcoin's maximum supply of 21 million coins.
You get, wow, a potential price of around $10 million per Bitcoin.
Again, highly speculative based on that market capture model, but it gives you a sense of the potential scale if it fulfills that store of value promise.
These models definitely paint an incredibly bullish long-term picture. And you can see why, in a world of constant money printing, people are looking for something different. That brings us to something really thought-provoking, potentially transformative. This strategy for building wealth that sort of flips traditional thinking on its head. The new rich Bitcoin wealth strategy, as our sources call it.
Right.
Why does this approach argue against the standard advice, save for retirement, then spend it all down?
It argues it's fundamentally flawed, basically, because that traditional model doesn't really grapple with the reality of our debt-based money system. It ignores the constant debasement of currency inflation and the fact that markets crash, cycles happen.
You risk running out of money.
Exactly, and you certainly don't leave a legacy. You're just trying to make it last until you die. The real game of money, the way the very wealthy often play it, is totally different. It's about acquiring scarce, hard assets, and Bitcoin is presented as a prime example here, and then never selling them.
Never sell.
The goal isn't consumption, it's building generational wealth, passing appreciating assets down through the family, not cashing them out.
Okay, that's a huge mindset shift. But if you never sell the asset, how do you, live? How do you generate cash flow without selling, paying taxes, and losing all that future growth?
Oh, that's the elegant part, according to this strategy. You leverage the appreciating asset with debt.
Borrow against it.
Precisely. In our debt-based system, where money is literally created through loans, borrowing against your asset allows you to access cash flow, often tax-free, without actually liquidating the asset itself.
Right, because the loan is an income.
Exactly. Selling triggers capital gains tax, and you lose the asset's future potential. Leveraging gives you tax-free cash, lets you keep the asset, and allows it to keep appreciating for potentially generations.
Okay, can you maybe walk us through a hypothetical example?
Yeah.
Looking back, how might this have worked with Bitcoin from, say, 2011 to now?
Sure. Let's run a back test based on the sources model. Imagine you started with just $5,000 invested in Bitcoin back in January 2011. Bitcoin was trading at like $0.30.
30 cents, okay.
By 2015, so just 5 years later, that $5,000 would have hypothetically grown to about $3 million.
Wow.
Now, here's the strategy. Instead of selling, you borrow a small, responsible percentage against that $3 million Bitcoin stack, say 5%. That gives you around $156,000 in tax-free cash flow for the year.
Okay.
These loans are typically short-term, like 1 year. So the next year, your Bitcoin has hopefully appreciated more. You take out a new loan, use part of it to pay off the old loan, and the rest is your tax-free cash flow for that year.
Rinse and repeat.
Exactly. And according to this backtest, even going through massive crashes like a 76% drawdown, at one point, this strategy consistently generated between $150,000 and $250,000 in annual tax-free cash flow, all without ever selling the original Bitcoin.
How do you manage the risk of, getting liquidated if the price crashes hard?
That's the key. Responsible leverage. By only borrowing a small percentage, the model uses 5% typically, maybe stretching to 20% only in severe drawdown years. The risk of a margin call is significantly reduced. The price would have to fall catastrophically far below previous lows to actually trigger liquidation with such low leverage.
That's a really powerful historical example. Okay, so what about projecting forward? If someone started today, say with $100,000 in 2024, how might this play out over the next, say, 20 years, according to this model?
All right, let's use the sources forward projection. Starting with $100,000 invested in January 2024, when Bitcoin was around $43,000. So that gets you about 2.3 Bitcoins.
Mm-hmm.
Now, using a conservative model one that assumes Bitcoin's growth rate slows down over time, but still kind of aligns with those big projections, like Fidelity's $1 million by 2030, and factoring in the 4-year cycles.
Okay.
By the year 2043, that initial $100,000 investment could hypothetically be worth around $37 million.
$37 million.
And importantly, using the leverage strategy, you'd only owe about $2.5 million in debt against that $37 million stack.
So massive net worth increase. But what about the cash flow?
That's the goal, right? This strategy, according to the projection, would generate annual tax-free cash flow, starting around maybe $75,000 per year initially and growing to about $230,000 per year by 2043.
And all without selling the original 2.3 Bitcoin.
Exactly. All without ever selling the underlying asset. This allows that original Bitcoin stack to potentially be passed down through generations, continuing to appreciate and throw off cash flow indefinitely.
It's a completely different way of thinking about wealth. But obviously, this sounds amazing, but there have to be practicalities, risks. What does someone need to consider based on what our sources say? This isn't financial advice, obviously.
Absolutely not financial advice, just exploring the concepts in the sources. And yeah, there are practical points. Access to these loans, for instance. Right now, it's mostly specialized crypto platforms.
Not your average bank.
Not yet. But people like Michael Saylor predict that within 5 years, major banks and institutions will offer these kinds of loans widely, just like they lend against stocks, real estate, even cars today.
Okay, so accessibility might improve. What about the risks? We saw crypto lenders blow up before.
For sure, risk absolutely exists. The biggest is liquidation risk if you use too much leverage and the price crashes hard. That's why the strategy emphasizes very low borrowing percentages. Responsible leverage is critical. And of course, understanding the market cycles helps manage that risk.
And could the government just make this illegal or something?
It's always a possibility with regulation, but the core concept, borrowing against an asset you own, is a standard, widely accepted practice in traditional finance across the globe. It's not some exotic crypto-only thing.
Right. Borrowing against assets is fundamental to finance.
Yeah.
Okay, so wrapping this up, we've really covered a lot. Compelling evidence for Bitcoin's potential continued growth from the on-chain data showing strength, the big macro trends providing tailwinds, and these powerful long-term valuation models.
Yeah, and that huge shift in market structure, with institutions moving in, potentially reducing volatility while driving demand. It's a different market than it was even a few years ago.
Absolutely. Which brings us to maybe a final provocative thought for you, the listener, to chew on. If this new rich strategy we explored, the one outlined in our sources about holding scarce assets like Bitcoin, never selling, and instead leveraging them for tax-free cash flow, if that really is becoming a viable path to building generational wealth.
Yeah.
How might traditional financial advice, the kind most people get, how might that need to fundamentally change to evolve for this new era of digital, provably scarce assets? Something to really think about, you know? It challenges that whole save, invest, then spend down model we've all been taught.
Subscribe to New Deep Dive.